Hi everyone, welcome and thanks for joining us today. I'm Chris Ashton, Head Mentor at the Corellian Academy, and I'm joined by Richard Adcock, our Technical Analysis Mentor, who will help me answer your questions at the end of the presentation. This is the second in our 5-part series on technical analysis for CFD traders using the Plus500 platform. Today's topic, price breakouts when they can and can't be trusted. In other words, how do we judge if a move through a particular support or resistance level is genuine or whether it's just a trap? Just some quick housekeeping points. The webinar will run for approximately 20 minutes. There will be a Q&A session at the end of the presentation, so feel free to add your questions to the Zoom chat or the Zoom Q&A that you have access to. And please note that trading CFDs involves risk, and this session is for educational purposes only. It is not financial advice. So why are we focusing on breakouts in this webinar? Well, because knowing whether a breakout is real or false is crucial for traders. False moves below support or above resistance aren't just frustrating, they can cost you money. But here's the good news. If you know what signals to look for, it can help you to filter the noise and find clearer, more repeatable trading opportunities. And that's what we'll explore today. Here's what I'll cover in the next 20 minutes. A quick recap of webinar 1, just as a refresher. I'll discuss what a price breakout is and why it matters. I'll look at when price breakouts can be viewed as more reliable, run through false breakouts and discuss how to protect yourself, outline 3 technical analysis tools to assess a breakout's validity, and then finish with a recent case study example of the S&P 500 index. Right, let's get started. Now, in our first session, we explored support and resistance levels and how they can be used to back up your day-to-day trading. We looked at why these levels form, how sideways ranges can develop, the potential supply-demand vacuums that they can create, and the typical price action that can result when one of these vacuums is hit. If you missed that webinar, check out the recording on Plus500's YouTube channel. A link to all of our previous webinars will be placed on the Zoom chat for you. In this webinar, I want to discuss breakout moves in more detail. More importantly, looking at what might help to provide a trader with more confidence in deciding whether a breakout is valid or is false, and discuss relevant technical analysis tools that can assist when gauging if a price breakout can be trusted or not. So let's start at the beginning and define what a price breakout is. A breakout happens when the price of a particular CFD that you're following moves below a support level or above a resistance level that has been identified, and then the price of that CFD follows through with momentum in the direction of the break. Why does this matter for traders? Well, a valid break of support or resistance can lead to a more sustained phase of price activity in the direction of the break. And because of this, it can be used as a potential trade signal. For example, a break below support may suggest further downside is possible, so a sell order may be appropriate, while a break above resistance may suggest more upside is possible, so a buy order may be more appropriate. A valid breakout signal can show the resumption of a previous trend or a potentially decisive shift in market sentiment. Think of it this way. A resistance break higher can indicate bullish confidence or positive trader sentiment within the market and can increase the risk for a continuation of price strength. Positive sentiment may mean as traders, we may only want to consider buying or going long of that particular CFD, as we may not want to go against the dominant uptrend in price action. On the other hand, a support break lower can indicate bearish conviction or negative trader sentiment within the market and risks for a continuation of that price weakness. Negative sentiment may mean as traders, we only want to consider selling or going short of that CFD to ensure we are not going against a downtrend in price activity. And spotting this all happening in real time can provide you with a trading edge. At this point, it's worth noting or worth stressing that breakouts are valid across any time frame that you may be using. Support and resistance levels are important no matter if you're monitoring a weekly chart or a 5-minute chart or any time frame in between. Let's now look at how to assess the reliability of a breakout. Now, not every breakout is equal, And market sentiment can be an important factor in deciding the validity of a break. As a general rule, these moves tend to be more reliable in two situations. Number one is trend in markets. An uptrend is a pattern of higher highs and higher lows and is an indication of positive market sentiment towards a particular CFD. For example, if the price of a CFD is constantly seeing buying support develop from a previous low, and then that buying can break above a previous resistance high, the price is deemed to be within an uptrend, a bullish trending condition showing positive sentiment. In this situation, resistance breaks higher are potentially more likely to gain momentum. And we can see this when we look at the daily chart of silver, and that's on screen for you now. Since the April 7th low, we can note how it has traced out a bullish uptrend pattern of higher highs and higher lows. This is an indication of positive market sentiment, suggesting that each time the previous price high is broken, it reflects a positive breakout to the top side, skewing risk towards the continuation of further price strength. Now, a downtrend is a pattern of lower highs and lower lows and is an indication of negative market sentiment towards a CFD. If the price of a CFD is constantly seeing selling pressure develop below a previous high, and then that selling breaks below the previous support low, the price is deemed to be within a downtrend, which is a bearish trending condition showing negative market sentiment. In this situation, support breaks lower are potentially more likely to see more follow through to the downside. If we look at the daily dollar-yen chart from the start of 2025 to the April lows, we can see this negative sentiment impacting prices. The risk of further downside moves increased every time a break of the previous low is seen, confirming the breakout to the downside and the potential for further weakness. You may have heard the saying, the trend is your friend. And this can be true because an uptrend or a downtrend is likely to remain in place as long as market sentiment towards that CFD remains positive within the uptrend or negative within the downtrend. Number two in this reliability of breakouts is a breakout from sideways ranges. A sideways range in price reflects a battle between buyers and sellers of a particular CFD. A breakout from a sideways range means that one side has overcome the other and is now the dominant force within price sentiment. When one side finally wins, the breakout carries real weight. To show you what I mean, let's look at a recent example of gold. The range formed with buyers being found at the 3,250 level, acting as a lower limit support, and sellers being found at the 3,450 level, acting as the higher limit resistance. While both buyers and sellers were found at these levels, the sideways range continued. And in this environment, it was more likely to see impatient traders lower their sell orders to the resistance level and impatient buyers raise their bids up to the support, helping to not only extend the sideways range, but also create, as discussed in last month's webinar, the supply and demand vacuums. This activity in price also suggested that an eventual breakout from this sideways range was going to be more reliable because it would represent an important change in sentiment from neutral, reflected by that sideways price activity, to either positive or negative, depending on the direction of the break. So looking at the chart of gold, we can see prices broke higher from the range on September the 1st, and then those prices accelerated, likely due in part to the supply vacuum that was evident above the old 3,450 resistance level. Now, before I move on from this section, I just want to recap what I've discussed so far. To help you, on screen now, the main points I discussed on breakouts from the trends. Feel free to screenshot this for future reference. Now you've seen that, here are the main points on breakouts from sideways ranges. Again, before I move on, I'll give you a chance to screenshot that also. All right, great. Now let's move on and look at false breakouts. Now, as I'm sure you're all aware, not every breakout succeeds. A false breakout can be both frustrating and costly because while initially appearing to represent a valid extension higher or lower in price, it fails to attract further buying or selling momentum, and then the price action reverses. False breakouts can happen when sentiment shifts suddenly, often due to economic data or a lack of trader commitment to the move. As an example, take a look at the 4-hourly chart of Bitcoin that's on screen right now. On August the 13th, Bitcoin broke to record fresh record highs, which looked like the start of a rally to even higher levels. However, the upside momentum stalled and prices quickly reversed. As traders, this type of move can draw us into executing a go with the break trade, only to find out too late that it's a false move as the market moves back against us, leading to a loss. The golden risk management rule in this type of situation is always consider using a stop loss. Define your risk before you enter, so if a breakout fails, you're protected. Now, thankfully, in technical analysis, we're not just guessing about the validity of a breakout. There are tools available on the Plus500 system to help us, and I'm going to move on to these right now. In this section, I will look at 3 techniques that can be used to assess any CFD at any time across any time frame. These are, number 1, volume; number 2, market sentiment using candlestick charts; and number 3, Bollinger Bands. Now, volume is a measurement of market activity occurring within the CFD for the period being monitored. In this example, we're going to look at daily data, but you can, as I've said before, look at data from any time frame. As this daily chart of Apple shows, that volume activity ebbs and flows for each session. But why is this useful? Well, the ideal setup within price and volume is that if prices are trending up or trending down, you want to see volume increasing as that trend evolves, be it to the upside or the downside. This increase in volume reflects there is a broader base support behind the price movement, which can offer extra confidence to traders that the move is valid and that it may continue further. Looking back to the Apple chart, on August the 7th, prices broke higher from a 3-month sideways range. In this situation, volume can be used to support the idea that the breakout to the top side is a valid one. Apple prices experienced higher volume before, during, and after the breakout than when it was caught in the sideways range. This increase in volume reflected broader base support for Apple prices as the important resistance level gave way, supporting the potential for a more sustained period of strength following the break higher. So a simple way of looking at it, rising volume for a CFD equals rising conviction in a move, and falling volume equals a lower conviction. Okay, so that's volume. I now want to talk about another approach we can use to help back up the validity of a price breakout, and that's sentiment using candlestick charts. We touched on candlestick charts in our previous webinar, but I want to build on what we discussed then. Now, the beauty of candlestick charts is that they allow us to gain a feel for market sentiment by comparing the difference between the open and close relationship during the period, as well as the direction of that relationship. The further a market closes from its opening price, the more significant the day is in terms of sentiment. If it closes higher on the session, it's regarded as positive sentiment, while if it closes lower, it's regarded as negative sentiment. The larger the real body of the candle, which is the difference between the open and close, the greater the market sentiment is for that day. To place this within the backdrop of price breakouts, we require positive market sentiment if we are analysing a breakout above resistance, or negative market sentiment if we're looking at a break below support. As a rule, the larger the real body of the candle, the more significant market sentiment behind the move. Let's look at the chart of the latest moves in natural gas since June the 19th, looking at the candles on the day a close below the previous low was seen. As you can see, each time a closing break under the previous low occurred, on June the 29th, July the 22nd, and August the 11th, each session saw large negative candles on those days, suggesting negative sentiment increased as a support level gave way. This helped to confirm the validity of the move lower in price. That was true until things changed on August the 27th, when natural gas managed to break and close above the August 21st last high in price, a move that was backed up by a large positive candle on that day, reflecting a shift back to a more positive market sentiment at the same time as a price breakout to the top side was seen. This helped confirm the validity of a break higher and the potential for further upside strength. As an example of when a price breakout to the upside didn't see positive market sentiment, let's look at natural gas on March the 9th. Initially, prices broke above the previous March 3rd high and would have appeared to be attempting a possible breakout to the upside. But by the end of the session, the market rejected the new highs and the session closed at the lows of the day at the same level the day began trading. This reflected a failure of positive market sentiment, as prices weren't breaking above a previous resistance level, suggesting the move wasn't valid, and then saw negative sentiment emerging that eventually led to breaks below support levels. Now let's look at our final indicator, and that's Bollinger Bands. These are a technical indicator that helps to determine not only the trending condition of a CFD, but also its price volatility and whether it's increasing or decreasing. So what are Bollinger Bands? Well, a Bollinger Band is a moving average envelope that consists of 3 lines. That's a simple 20-period moving average, which is called the mid-average, and lines above and below the mid-average that are called the upper and lower bands. How can these bands help us to judge if a price breakout is valid or not? Well, Bollinger Bands show volatility in price. Due to the formula and calculation, if price volatility is increasing, whether to the up or the downside, the upper and lower bands start to widen. If the mid-average is also rising while volatility is increasing, the conclusion is that an uptrend in price is evident. And because volatility is increasing, shown by the bands widening, the uptrend can extend further. This will potentially continue until volatility starts to decrease, which will be signaled by the Bollinger Bands starting to draw together or contract. A downtrend is reflected by a fall in mid-average, with increasing price volatility signaled by the widening Bollinger Bands. In this situation, the conclusion is that the current downtrend can continue because we are seeing increasing volatility within that downtrend, which will likely remain in place until price volatility starts to ease and the bands draw together. And it's at this point, when the bands draw together, that risk can turn towards a potential consolidation in price. And as traders, we may want to consider closing our position and then look at and assessing what happens next. To help confirm if a breakout is valid or not, when important support or resistance levels give way, we could look to assess what the setup in Bollinger Bands shows us. Let's go back to the gold example and then include Bollinger Bands to show you what I mean. As you can see, on September the 1st, breaks above the June 15th high, which was 3,452, materialized, which we've already established mark the upper extremes of that sideways range. At that time, Bollinger Bands offered 2 confirmation signals to suggest the break higher was valid and can possibly lead to an extension of price strength. First, the mid-average was rising to suggest the market was already forming an uptrend pattern. But more importantly, the upper and lower bands were widening, confirming positive price volatility was evident, skewing risks towards a continuation of further price strength. If volatility continues to increase, shown by the widening bands, we can be more confident that breakout momentum can continue higher and potentially will remain in place. So as we come to the end of this section, we've looked at 3 indicators and techniques that can help us to have more confidence in price breakouts. Before I move on to the final part of the webinar, the S&P 500 case study, like with the other sections, here is a summary of the main takeaways we have discussed, just in case you would like to screenshot them for your reference. So to build on the idea of price breakouts in practice, let's look at the S&P 500 index since the April 7th low to visualize how upside breaks in price have helped to maintain a positive trend. Since the April low, a pattern of higher highs and higher lows has formed, which has reflected a bullish uptrend, and this pattern currently remains in place. Within this activity, each setback in price has found buyers at a higher level, and that buying has been able to break the previous failure high. Each time such a break to a new high is seen, it was with a large positive candle to reflect positive sentiment was ongoing, and that offered evidence that it was a valid break each time and that the strength could continue. Let's now add Bollinger Bands to the chart. You can see the mid-average has continued to rise since the April lows, confirming a positive trend was in force, and that any breakouts higher had the potential to continue that positive pattern. The widening of the Bollinger Bands as the new recovery highs were registered also added further support to this view. Within this backdrop, the conclusion is a positive trend has been evident within the S&P 500 index since late April, and that this uptrend has been seen alongside both positive market sentiment and positive price volatility, maintaining risks of moves to higher levels. Looking at the current activity in the S&P 500, it's difficult to know if the uptrend can continue. But if new highs are seen again, it will be important to watch to see if the move attracts positive trader sentiment reflected by a large real body to the candle on that day, and if Bollinger Bands starting to widen again if new highs are hit. If these signals aren't seen, it could place a question mark over the validity of the move and even lead to a more extended phase of price weakness. Right, that concludes the presentation part of the webinar. I can see there are several questions already, so let's look at them with Richard.